Interesting, just looking anecdotally, the number of commercial real estate panels, professionals, investors that we've seen this week has been a significant increase. I don't know if SFIG's trying to put CREFC out of business, but just based on that, it would seem that we're seeing a real resurgence. If you look at where the market is, Kunal, where were we this year, you think, or last year, 2017, in volume relative to 2016?
Sure, yeah. I mean, it's been a slow climb out of the financial crisis. CRE, CDOs, they were called back in the day, was a pretty big product in sort of the 04, 05, 06 period. The product that's been reinvented, and we're going to spend some time talking about it on this panel, is very different for a variety of reasons. Last year was a breakout year for the product. It was about, like I said, about $8 billion of issuance. The year before that, it was $2 billion. The other notable development last year and a sign of a real market and a product that's here to stay is the number of issuers that are active in the space. And so, not to advertise for Gene, but between 2012 and 2015, it was really Arbor Realty Trust and maybe one or two other issuers issuing in what was a pretty niche product that not a lot of people were paying attention to. Last year there were double-digit issuers. Our expectation for this year is this is the fastest growing part of the commercial real estate securitization market, probably 15 to 17 billion of issuance, and anywhere from 15 to 18 issuers is my projection of how many issuers, including maybe 6 to 9 first-time issuers issuing.
I was expecting another quadruple to 32 billion, but you don't see that. First-time issuers, that's interesting because this is a difficult space. I think if you look at CRE CLOs relative to middle market or other corporate CLOs, a lot of times what we're talking about is the nomenclature, because these deals look a lot like CMBS. As Kunal said, we're talking about first lien mortgage loans for the most part. I think that's why we talk about post-crisis CRE CLOs as opposed to pre-crisis where we had CRE CDOs. But with all the new entrants coming in, Tim and Gene, I'll ask you, was it difficult, Tim, to do your first deal? What were the challenges as you look at this? Because it's lumpy, the collateral's different. It's not like just taking corporate debt names.
Yeah, I mean, I think anything at CMBS is a process, right? And I think for us, where we focus on the smaller balance part of the curve, it becomes even more of a process. We have more line items in our deals. We're kind of doing $7 to $10 million average balance loans. And so that just takes a lot of time and resources to kind of get a deal done, to get the agencies to review all those loans, to go out and see them, to do disclosure on all the material items there. I think that's been the hardest part of being a first-time issuer. We issue on the fixed rate side as well, so very familiar with the process and have a bunch of deals out there. But our first time for the CRE CLO is kind of a function of kind of getting people acquainted with our collateral and taking the time for the line items.
So, Gene, what's the motivation to doing a deal? A lot of times when we talk about corporate CLOs, you might see arbitrage CLOs. There's a pickup. You have a manager who's going out in the open market. CLOs have been talked a lot about. What's the motivation in the CRE space for you all to do this?
Well, for us, which I think we're representative, it isn't an arbitrage vehicle. We're not an asset manager. It's actually financing for us, as I think it is for virtually everyone else in the space. So that's the motivation. It's financing. We retain, as we have in all of our transactions, all the exposure below investment grade. And for us, that tends to be about 20 to 25% of the capital structure, which obviously is a significant number, particularly when you're talking about first mortgage collateral. And in our case, it tends to be 75% plus multifamily at that. But for us, it's a nice complement to bank lines of financing, which we also have. So we found since 2004, when we issued our first transaction, that those two, serve slightly different purposes, and they can really, there's a synergy, I think, if you have a good balance between the two. And at any point in time, the securitizations for us typically represents about 60 to 80% of our financing for our loan product.
So, and Kunal, I'll just throw this to you for a second. Do we see that corollary? Is it a either or? So if rates come in, if you print a deal tight, do we see less in the warehouse business, less term financing? if we're looking at this as a financing vehicle, and if rates blow out, people are going to look more to the banks to finance?
So it's an interesting question. I mean,
Thank you.
to be clear, I think there's some clear advantages that a securitization vehicle has over bank repo financing. It's match term, it's non-recourse, and non-mark-to-market. I think this is a space for established commercial real estate origination platforms. This is the key concept. These are firms that have headcount, they have infrastructure, they are lending as a business. They're predominantly REITs, such as Arbor. I think it is a very good complement to have in addition to bank line financing. Certainly, there will be some, just based on where spreads have been over the last 9 to 12 months, opportunistic type of issuers. They may say that, look, I've been using bank lines, I've got 5 bank lines or 4 bank lines. Now my cost of funding from a securitization vehicle and my advance rate are both significantly tighter than or better than what I can get from a bank line. I need to do this because I'm at a competitive disadvantage if I don't from a cost of funding standpoint. And so, let's say bank lines are anywhere from, depending on the type of collateral, and we should talk a little bit about that, high 100s to 250 over LIBOR. These are, LIBOR-denominated loans, LIBOR-denominated liabilities. Depending on the type of vehicle, whether it's static or managed, cost of funding from securitization has been anywhere from 60 to 80, 90 basis points tighter than repo at advance rates that match or exceed repo. So my hope is that, what we're seeing is the establishment of a product, because capital market spreads will ebb and flow. They will certainly widen out at some point. But the issuers and the clients we're managing and advising are really mostly focused on setting up brands and programs that give them liquidity and access to another source of funding over time. I'm not really interested in advising issuers who are interested in a trade opportunity. That's not what we're doing, and that's not healthy for the market. I think that's one of the issues or flaws that maybe led to some of the issues pre-crisis.
So let's talk about that a little bit. I'll throw that back to you. Other than having really good, competent counsel, what are some of the things that a first-time issuer needs to think about as they go into this process? Because as Tim said, there's a lot of work in setting it up. I'm assuming we have a lot of people who might be interested in the audience in doing a deal. Isn't it just as simple as taking your collateral and you go to market?
Well, you need really competent bankers, too. So,
and the right rating agencies. Understand your collateral. Right?
This is unlike CMBS, and there's lots of similarities. I mean, a similarity with CMBS is the collateral is all first lien mortgage collateral, but this is really a bespoke product. This is really, every deal is different. Every issuer has a slightly different orientation, the types of loans they're originating in, the markets they're originating in, how transitional are the bridge loans. So some are heavy transition, which means you have a lot less cash flow going into the deal. Some are moderate transition, which means you've got some amount of business plan implementation risk, and then some are very light transitional, meaning you're going into the deal at a very healthy cash flow, the loan's covering with cushion, and there's a business plan, but the difference between as is and stabilized is pretty modest. So I think, again, this is for established originators. This is not something that anyone sort of thinking about, well, this is a real opportunity, I should think about getting into this, and I can hire a couple of people, hire a couple of originators, and this is an opportunity. No, these are not arbitrage vehicles. These are not AUM exercises. The deals are all characterized by very conservative capital structures. The issuers are generally holding anywhere from 15 to 30% of the risk. So these have a lot less leverage in them than corporate CLOs. I personally think they're misrated on the conservative side. Just to give you a little perspective on that, pre-crisis, CRE CDOs they were called back then because they included, in addition to loan collateral, mezzanine collateral, subordinate debt, preferred equity. Sometimes you would have bonds, REIT debt. The typical leverage profile back then was 8 to 9 times leverage, and so you had an advance rate through BBB minus, and I'm sure Gene could speak to this from some of his deals pre-crisis that were 7, 8 points enhanced, Now you have a much better security. Your collateral is first lien, 100% first lien, no sub-debt. So you've got mortgages, you've got diversification, you've got originators who are also asset managing, and they are retaining real skin in the game. CMBS, by contrast, is not a skin in the game business. It's a gain on sale business. We do have to comply with risk retention, but putting that aside, we originate loans to sell risk and sell that efficiently.
Yeah. Interestingly, this is not a space where risk retention was really ever an issue because there was not a lot of arbitrage deals that were done. Nitin, because you were mentioned in the last comment, you'll have 30 seconds to rebut Kunal, but how does the collateral differ when you look at CMBS versus, Kunal was talking about transitional, light touch, moderate, heavy. How does the collateral differ? And then how important from your perspective in the ratings is the collateral versus the collateral manager, especially in a managed deal?
Sure. Look, I think we've got a very experienced team. I think when you kind of look across the street, at Kroll, we've got numerous people who've done this in 1.0 since the early 2000s, both from a banking perspective and structuring perspective. I was at Wachovia doing CRE CDOs. You got our sort of legal folks have done this in 1.0 as issuers counsel, and our team has people surveil these transactions at rating agencies, right? So we've seen what's gone right and wrong. So I'll just agree to disagree with Kunal on whether these are underrated or not. These do have much higher credit enhancements than 1.0 deals, which had quite a bit of varying performance, and they do have much higher credit enhancement than conduit CMBS, which they should, just because of there's significantly higher risk in the collateral and the collateral failing. You're talking about every asset in the pool being transitional, and it might be 25 assets. The top 2 assets could be 20% of the pool, and all you need is 2 assets to have 70% severity. It could be 14% loss, and a conduit BBB credit enhancement of 7 or 8% is can withstand a little bit more than just 2 average size loans defaulting with losses, right? So look, there may be matters of perspective on the risk. In terms of how we analyze these deals and how we sort of kind of compare and contrast, the first thing I do want to point out and sort of echo Kunal's sort of sentiment. This is a new emerging asset class. Right? This is very different from 1.0 CRE CDOs. 2006 and 2007, we had about $35 billion of issuance a year in that asset class. 20 to 25 billion of that was re-remix. It was re-remix of CMBS B pieces, BBB, some AAAs, REIT, and of the remaining 10 to 15 billion, a lot of that was securitization of mezz notes, B pieces, rake bonds. Very small fraction of it was 100% first lien collateral. Right? In fact, I kind of went back, looked at some numbers. Information can be a little bit spotty in this asset class historically, but there were less than half a dozen deals which were 100% CRE collateral. And even some of those had small 5-10% mezz buckets. So this is very different from 1.0 sort of transactions. For us, collateral and manager, it's the holistic analysis is important, and the relative importance of collateral and manager varies depending on the type of a deal, right? These deals sort of range from like purely static, where there is absolutely no ability to acquire or reinvest into assets, to what I classify as lightly managed or static-ish, where you can reinvest proceeds into pari passu portions of assets that are already in the trust, to truly managed deals like that Gene does at Arbor, where you can reinvest into assets that are not pre-identified, but they're subject to certain reinvestment criteria. And as you move from more static to more managed, the importance of the collateral manager and the sponsor increases in importance quite a bit. Even for the static deals, there is certain importance and certain sort of comfort you need to get around.
Because of the transitional nature.
Because of the
these assets
transitional
you wanna
nature,
know.
there are certain decisions that are vested in the sponsor. Future funding decisions. These are a little bit more hands-on managed versus non-recourse debt. On a managed side, certainly it's not only just the transitional natures of the assets in the pool, but it's also you got to buy into the philosophy of origination
And the platform.
You got to buy into Arbor's platform and their philosophy of originating the assets. So there's varying degrees of how important a collateral manager is. That said, the collateral is always important, right? You can have the best manager, but highly levered and low quality collateral, that game's not going to end well. So collateral is always important, right?
And unlike a middle market CLO or other CLOs, these assets don't come with ratings. So you're looking at all the assets, whether it's managed or it's static. You're going to look at the assets kind of de novo on each.
Yes.
Tim, your deal, you chose to do a static deal. Semi-static, or what was the term you used, Nitin? A microstatic, or
We were
Static-ish.
Static-ish, right?
So the reason we did that, we were a first-time issuer in the space. We thought it was the right way to go out and show investors our collateral and our structure in the most conservative fashion. And so that's why we went out with a really investor-friendly static deal. We have the ability to buy in a de minimis portion of kind of future fundings that occur over the course of the transaction, but we definitely wanted to go static for the first time. I think as we go forward and as this market evolves, we'll continue to explore options. I think for us, it's what's the cost of doing a managed deal versus the benefit to the business. It also allows you to kind of create a more stable return and a more stable duration profile for the front bond. So I think what we don't want is to go through all this pain of setting up a deal, have the A-bond delever too quickly, and kind of have a very negatively convex portfolio. So I think for us, it's really kind of weighing all those costs and benefits.
And some of it's got to get to the tenor of your assets, right? How long-term your assets are. If you've got short-term assets, that cost is more acute, right, to do a new deal. To be clear, from the legal perspective, we really like a lot of issuances. More frequent issuances is better, to come to market. But I can understand why you would want to not pay that cost too often.
I think we should spend a second talking about static versus managed, right? Why do issuers issue to managed? And I think, Gene can speak to why they issue managed. But, the tenor on the collateral here tends to be anywhere from 2 to 5 year loans, floating rate loans. And
without call protection or limited call protection.
Yeah, right. So if you're originating loans that have limited or no call protection and you're doing very light transitional, let's say, bridge to agency takeout, which is a lot of what Gene does. These are pools where the loans are predominantly multifamily, they're very light touch, they're cash flowing, they're getting taken out by some type of agency takeout. The need to do that there is definitely going to be a lot less.
Right. Yep. So that's a good point, Gene. So you were pretty insistent at the beginning, and I would say conservative as well, just to give you the benefit of that characterization. When we started doing your first deal, that there was going to be some management. And I think it's important for those of you who are comparing and contrasting. When we talk about management, there is no discretionary trading bucket. It's very light in terms of what can be traded out, which are defaults or credit impaired for the most part. And so it's not the same as what you might see in a corporate CLO. But you were very insistent on the idea that you were going to have a management feature. Why was that important to you, and how do you get investors comfortable with that?
Well, I think structure is vital, and it's easy for everyone to just compare static versus managed and try to boil everything down to two categories. But I think it's nowhere near that simple, because I think in some respects a managed deal can actually be more conservative than a static transaction, and vice versa. So I think largely it comes down to structure. If you just take the collateral as a given for a second and you focus on the structure, as Stu, and Kunal well knows for that matter, we we endeavor to demonstrate to the investors that our structure is vital, is very conservative, in a few senses. But basically, on a CLO, there are coverage tests, and we have one series of coverage tests. The notes are all non-pickable. And if they're paid their money, we get the residual, and if not, we're shut off. And furthermore, we structure it such that we have virtually no cushion whatsoever in the test. So the reality is, if we have, in all likelihood, a single default, that will trigger a coverage test, which means that we're shut off from cash flow, and we've also structured it that our reinvestment period ends if and until that test value is restored. So if there's a hiccup, it basically becomes a static transaction unless that test value is restored. The likely way you can do that, even though you're not legally obligated to do so, you're economically incentivized to remove a loan at par plus accrued and put in a new loan that meets the eligibility criteria. So if you're structuring a deal something like that, where there's virtually no cushion and the incentives are such, I think depending on the issuer, the collateral, et cetera, and what the terms are in a static deal, I'm not sure that bears any more risk than a lot of static deals, maybe not as much as some. So I think it depends on a number of factors. It's not quite so simple as saying it's static versus it's managed. We have spent literally years developing this because we've tried to demonstrate to investors that whether it's our program or other programs, these are the sorts of things that you really should take a hard look at and price accordingly. But I don't think it's so simple as a static market and a managed market.
So let's talk a little bit then about investors' perspectives, because without investors, we can't do deals. Nitin, what do you hear from investors, or what do you emphasize in your pre-sales on these types of deals? What's the feedback that they're looking at?
Yeah, I mean, look, the way we analyze deals, present to investors, and some of what they ask us is, I'll bucket it into sort of three categories: is the collateral, is the deal structure, and the deal sponsor. Like I said, collateral is I think almost always sort of the most important aspect of a transaction, because you can have the other two prongs structured as good as you want to.
But within the collateral, and then I'll open it up to the other panelists, because you're on road shows, you're hearing from investors. What's important on the collateral? What's important? What do we drill down to?
It's for us, collateral. First of all, we're touching every asset in a pool, which it may be different from other agencies, may be different from corporate CLOs where there might be ratings existing. We're touching and diving into each asset, and because these are transitional, how it sort of differs from, let's say, conduit CMBS assets, which are more stabilized. It's more about understanding the business plan, getting a buy-in into the business plan, who's the loan sponsor. That's, even though many of these loans can be non-recourse to the borrower, the loan sponsor is important because you're relying on their expertise to be able to.
So at the borrower level, what's going on in the property as opposed to the origination platform?
Yeah, both actually, right? The borrower level is less important in conduit CMBS because these are non-recourse assumable loans. Right. But here, while they can be non-recourse and some extent assumable, it's the performance or success of the business plan is really very heavily dependent on the loan borrower and also the origination practices and the sort of the controls that the lender has, right? So that's something sort of fairly different. You have to understand the business plans, the transitional natures, whether it's cash flowing, non-cash flowing, and evaluate the trade-off. Or are you better off buying into a business plan of a newly constructed multifamily in Williamsburg, which is almost vacant, or an 80% stabilized asset in a multifamily asset in suburbs of Nashville, right? Where the play is to add a few more dollars, right? There's trade-offs.
So what's the answer?
Look, it's
I'm
it depends.
Kidding, but these are the decisions that they're making across, especially Tim and Gene, as there's more deals, Kunal talked about how many new issuers are. Are you surprised, or what's the feedback you get from investors when you're on a roadshow? What do you hear?
Well, I mean, I think to be clear, the issuers, most of the issuers at least, if not all of them who are first-time issuers, are not first-time lenders, right? That's an important difference.
They've been lending, they have lending platforms, they've just been relying on other sources of financing to fund their activities. In many cases, they were active pre-crisis.
Okay. So all of you were involved when we talked about pre-crisis, right? All of us were, well, I didn't do any of those deals, but pre-crisis, we were all involved. What are the differences? You know, Tim, you were at DB, and what are the differences you see in the deals now versus 1.0? What are the kinds of things?
Yeah, and I think Kunal and Nitin hit on these earlier. I mean, it's the collateral types, it's lighter leverage loans, it's more focused on sponsor, and it's less kind of, you know, carte blanche flexibility for the sponsor to manage the transaction in a way that might be arbitrage as opposed to financing. I think it's a totally different market post-crisis, and I think investors have, you know, definitely accepted that model and have given credit to issuers for that.
Gene, you agree? I mean, are you seeing any of the same mistakes that were made? Are there features that are different?
It's a very different market. I think it's a very healthy market today. I think Kunal began this by saying it's been very slow developing. That's absolutely right. It's been 5.5 years in the making. We did, you know, first CRE CLO coming out of the crisis in September 2012. Over half a decade ago, 5.5 years ago, and here we are talking about, you know, a relative boom. So it's, you know, it's been very slow in the making, and for good reason, I think. But the deals are vastly different. Frankly, they're unrecognizable today versus what they were. I think there's little comparison to make. If you went back and you looked at our indenture or virtually probably every other indenture from pre-crisis, the complexity involved in those was frankly mind-numbing, and as Stu can tell you, we spent a tremendous amount of time developing that complexity for a lot of reasons, but the deals worked. You know, our deals, even with subordinate collateral that range from literally 65 to 70% subordinate collateral, mostly mezzanine, in our first CRE CDO back in 04 through 06, which had 80% senior, 20% subordinate. You know, just the nature of the collateral was different, albeit it was loans. It was loans that we had on our books. We weren't doing securities. But the nature of that collateral was different in terms of senior sub. Also, now we have a multifamily heavy focus, then it was more diverse. The leverage point, as Kunal pointed out, we had nearly 92% leverage, 92% through BBB minus on a pool that was 80% senior, 20% subordinate in 06. Today we have 75 to 78, 79 on 75% multifamily first lien product. So obviously the collateral is vastly different. The leverage points are very different. Our deals, which I think are pretty reflective across other managed deals, the structures are vastly simpler than they used to be now. We went out of our way, in fact, in 2012 to create a deal such that if you had no experience whatsoever in securitizations or CLOs, you could very quickly understand the structure and just look to the real estate. Alternatively, you could, you know, if you knew securitization, of course, the structure you would recognize was a simple one, but anyone could come to terms with the structure very easily. The complexity of that structure today is really no different than it was in 2012. It's still very simple. We've actually added more investor-friendly bells and whistles to protect the investor because we try to narrow the gap between pricing on a static versus a managed deal, so we've taken great pains to do that. But I think in virtually every material respect, the deals are different today from what they were then. Again, they would be virtually unrecognizable. If you haven't looked at a pre-crisis indenture and you went back and took a look, you wouldn't even know that it was the same market. And I think it's, in part due to that, it's a healthy market, but investors are the one who puts the brakes on it. So We just need investors to continue to be diligent and ask the right questions and, participate accordingly.
And I think, investors by and large have recognized the structure and the integrity of the structure. I mean, we have an incentive here as a sort of a leader in the space, not just to advise our issuer clients on structures that achieve their goals, but we have a very strong vested interest to ensure that investors on the other side, who are also our clients, are buying into deals that fix many of the issues that existed pre-crisis. The elimination of discretionary trading, the over-collateralization test is a critical test, particularly for managed deals. We've taken we spent a lot of time both with issuers like Gene and with some of the largest investors who have asked us, how can we get screwed by this test? What have you done to fix it, to avert gamesmanship that did occur, unfortunately, in the crisis, where legally managers were able to do things permissible under the docs. For example, modifying a loan to avoid the OC test. There's a loan that's not performing. Issuer says to borrower, I'm just going to change your coupon to a zero coupon. I'm going to give you 2 more years of term. That loan suddenly doesn't count towards the numerator of the OC test. Well, that shouldn't happen, right? That is exactly what the OC test is designed to protect investors for. And so now our OC test definition includes a modified loan test. If you modify a loan and you have a material mod, you have to order a new appraisal. That appraisal reduction technology is borrowed from CMBS. It's a good feature to have. So not only are you now looking at the lower of a Moody's recovery rate or market value or an appraisal, which will show you degradation in property value, that is supposed to capture that. So we've gone through great pains to come up with a structure that is able to perform. And of course, the enhancement levels, as Nitin talked about, the rating agencies have certainly, they have fixed many of the issues that were clearly flawed. Pre-crisis deals probably had too much leverage. Now they're certainly conservatively rated. I don't think anyone's going to look at these and say they don't have enough enhancement. The AAAs have about 45 to 50 points of enhancement to AAA on first lien collateral. I don't think you're going to find a lot of asset classes in any ABS structured finance arena with that much enhancement, particularly when you're secured to a hard asset that generally is producing
that's
cash
the
flow.
enhancement at the loan level. That's forgetting the implied or real equity that there is at the
Sure,
property level.
sure.
Right? So Nitin, do you want to comment on that, because I saw you taking notes?
No, it's I think I agree with all what's said. Right, it's I've played in the 1.0 space on the banking side and now on the rating agency side. At least from a ratings perspective, some of the missteps that I saw when I was on the banking and structuring side was, I used to scratch my head then, and now I have a chance to kind of fix those. Right, it's things like. While analyzing in 1.0 deals, right, there was a certain amount of analysis that was done on collaterals, whether it was Moody's, S&P, or Fitch. But then ultimately, sort of the results of those assets were, you had some sort of a shadow rating, and highly levered loans, all shadow ratings, let's say, would tend to be like CCC, give or take, and you fail to distinguish between an 80% LTV CCC and a 100% LTV CCC, and frankly, sometimes it had like 120% market LTV CCC asset. All of those would get treated when you shove them into like some sort of a simulator. You get sort of a similar outcome. So you lost, and when you sort of bundle together a lot of subordinate collateral. And they get treated the same way, whether it's 80% LTV or 90% LTV. That used to blow my mind in like 2006 and 2007.
So that's the application of CDO technology or corporate CLO technology to an inherently different type of collateral.
Absolutely.
So Tim, from your perspective, right, now we know the investors are smarter, better, doing their work better. Clearly the rating agencies are smarter, better, doing their work better from understanding this. As an issuer, you've now got a 300-some-odd page document that you're putting out on the collateral. How's that process work for you? You have a lending platform, you're making loans. All of a sudden, you've got a capital market execution. What are some of the challenges, the things that an issuer has to do that a lender may not be thinking about doing?
Yeah, and it's a big change. I mean, I think for us, we do have a lot of different securitization programs, so we're well suited to kind of step into this market, as Kunal mentioned, not just as a lender who's doing this for a long time, but as a securitizer. And so I think what that comes with is kind of being forward thinking in terms of, having your deal counsel and your underwriting counsel synced up in terms of risk factors and disclosures and all the different items that are in these transitional properties, because it's not a good way to start kind of when you go to securitization. You need to be thinking about how you're going to disclose all the different elements of the loans when you originate the loans. So that was kind of the biggest thing for us in terms of preparing the program.
And what do you guys have to do, Kunal? So JP is a leader in this. You're a leader in CMBS. You've got a team for CMBS that does this. It's very broad. You walk into somebody. We're not talking about two people in a Bloomberg anymore, but you have an origination shop. What do you guys have to do with somebody who wants to come to market?
Well, I mean, I think Tim hit the point well. I mean, this may have been their first CRE CLO last year, but they issue a ton of securitizations in all sorts of asset classes. So having a lender issuer who has some capital markets experience and expertise is certainly important and helpful. For us, advising issuers, new issuers or existing issuers, there's really two broad components or three components, right? One is determining the type of transaction they're going to do, static or managed. That's a big decision to make. Not everyone is equipped or capable, and frankly, we wouldn't necessarily sponsor them as a managed issuer off the bat. One of the characteristics that would lend to a issuer being able to issue managed would be having really short collateral, where there's a very easily articulated thesis to investors on why they're issuing a managed deal. If you've got short collateral, 1-year collateral, no call protection, these deals don't really have enough leverage in them to withstand prepayments, right? So that is why Gene would probably it's too prohibitive for him to issue static with the type of multifamily loans he's making. The other two buckets are guiding the issuer through the rating agency process, which is much more involved. It takes a lot more time, a lot more resources than any other rating product, frankly, in the asset-backed arena. These loans are not rated going in. They get rated. Agencies do the work. They go out and see the properties. They form their own view on the business plan. So that is a process that can take, 4 to 6 weeks. And then as we're kind of going through that process and figuring out a structure, we also have to then figure out what the appropriate strategy is and what the messaging is to investors. Like I said, the deals are bespoke. Every platform is different, right? I mean, Gene's got a multifamily heavy platform. Tim on the other side has a slightly different orientation where they're lending on all types of CRE, maybe more transitional in terms of spectrum of the types of loans they're doing. So those require and dictate for us to have very different strategies in how we present the deal to the market and to investors. And how is the deal marketed? Do we, for a first-time issuer, focus on more of a sort of club-style program where we go out and spend several days and, frankly, meetings and follow-up calls with investors to introduce the program, and then kind of over time on their second deal and the third deal roll out a more broadly syndicated program? Or the deal's really generic, it's a static deal, very light transitional, household name. And so a couple of large financial sponsors recently have done transactions. Some of the largest financial sponsors in the space have done billion-dollar CLOs. Those, I think there's more liberty for the underwriters to go out with something right off the bat that is more cutting edge, maybe a little bit more aggressive. But when I say aggressive, I want to be clear that aggressive isn't not investor-friendly aggressive. It's just doing something that a less household name with less of a track record, you've got to prove your track record. You've got to establish a track record. A track record's not a gimme, and I think to that point, this year and last year we started seeing it. You're going to start seeing more tiering of names. There weren't enough issuers in the space to have real tiering the way you have in the corporate CLO market. Now there are, and folks who've done 9 or 10 transactions or who have securitization experience in other asset classes, you're going to start seeing tiering and how deals price and how investors participate in deals, and we're already seeing that.
So let's use that as a launching pad, because I want to leave a couple minutes at the end, because I'm sure there's going to be literally hundreds of questions. But where do we think this market's going, right? We've talked about $2 billion to $8 billion, $8 billion to $15 billion. Nitin, do you think, where do you see the market going in terms of volume, in terms of frothiness, in terms of changes? What's your view?
Yeah, I mean, look, I'm not sure about 15 to 18 billion, but I do see like a healthy growth relative to last year. Last year, 18 deals, 7.7 billion. This year, I think you can easily touch 10. I think 10 to 12 billion, about 25, 27 deals. Remember, now you do have, I think by the end of the second quarter, you'll have 15 active issuers. You need a deal and a half each to get to 25 deals. The average deal size is about 500 million, ranges from 250 to $1 billion. So, that's a healthy 50% growth relative to last year. So I think that continues. I do think that you see a little bit more managed as people get comfortable with issuers and the asset type, frankly, right? It's, even as early as, or as late as last year, there were some investors, or CMBS investors, who participated in 1.0 CDOs and are active CMBS investors. They didn't realize the concept that these were all 100% first lien collateral. That was, so there's been
That's surprising.
it was surprising to me, right? And we're in like year 5 of this.
I think during the course since the downturn, there's been one deal that was a mezz deal, and that was a static one deal, but everything else.
We did rate that detail.
Tim, where do you see the market going? I mean,
Yeah, I mean, I think we're at a really good part of the cycle. I mean, I think you have kind of moderate, well-paced growth, somewhere in between kind of where we were this year and kind of the $15 billion number that Kunal mentioned. I think there's just a lot of alignment out there right now. You have a lot of subordination. You have conservative structures, even when they're managed. You have investors who are kind of growing their short duration floating rate books, and you have a rising rate environment. So I think that all facilitates like growth in a very stable way for this market, I think.
Gene?
I agree.
Good. Well put. What about the investor base, Kunal? Are you seeing that grow with more deals getting done, right? Is it going to be the same pot, or are we seeing the pie growing and we're seeing more investors come in?
Yeah, I mean, I think I alluded to this earlier, but this may be the most well-bid and liquid part of the CMBS market. And so the participation rate in the deals, and we kind of track this, but we led 9 deals last year. I think on average, the pot list breakout by sector was probably 50 to 60% money manager, 20 to 25% bank CIO type guys, and then maybe 10, 15% credit, hedge funds down in credit. And so it is already a very deep buyer base. It's generally short duration, it's LIBOR based. That's where a lot of the money managers have seen flows. I also think there's been an education process, which I'd like to say JP Morgan's done a lot over the last few years, invested time with issuers like Arbor and educating some of the larger money managers who did get burned and were not happy with how the structures from pre-crisis performed. I think that has paid off now, where they have come back in, entered the sectors. They've acknowledged it is, as Gene put it very well, unrecognizable deals today versus deals before. So I think, for sure, we continue to want to educate and maybe bring in some more crossover investors who may not really know what these are, what they're backed by. They offer attractive relative value and spread pickup versus many other asset classes. They have ratings from 2 agencies.
We really have seen that change, right? Because the first deals that we saw, rather not even addressing whether it was static, there was a lot of look at how do we make this look like CMBS? How do we get investors comfortable? And I don't want to use the word aggressive because that implies something I think that we're really not talking about. But we are seeing wrinkles added to structures. We are seeing new innovations as the market continues to get educated. People are understanding it. The one thing, and then I'll open up for questions. The one thing that's coming from this panel really seems to be good loans make good deals. I've spent a lot of time playing poker here, and good cards make good poker players, right? So good loans make good deals overall. So I think as people get more comfortable with issuers, with people who have done a bunch of deals, who have a platform, they're going to accept a little bit more.
And that's what tiering is, right?
Right.
That's what tiering is.
So I'm going to open it up. I don't know if anybody has any questions. Yes?
I have a mic here if you'd like to speak into it.
Quickly.
Sorry.
I'm not really familiar with this sector, but those deals that I see, a lot of them have a AAA from Moody's for the top tranche, but there's no rating after that as far as major rating agencies. I feel like that might be limiting some participation from some investors who are restricted from investing in tranches without any major rating agency rating. So wondering if you, as your banker and the issuer, do you guys have any plan to change collateral quality or structure-wise to, get some major rating agency rating on the down and credit?
Yeah, I mean, I think we should talk after the panel, but, I don't think there's a credit quality issue. Kroll is a fine rating agency. They're very well accepted and entrenched in the CMBS market. They may not be maybe as well known in other sectors, but I think the implication that credit is preventing major rating agencies from rating down the stack is not true. I think there's some major rating agencies that are frankly not active in the space, and there may be some model limitations that one of the major rating agencies has in the modeling techniques they're using for this product that, in my opinion, are very flawed, which prevent them from rating down the stack. I would look at where Kroll rates deals and maybe one of the other agencies as more indicative of what the rating should look like in a CMBS methodology.
I'll agree with what Kunal said early on, right? I think some rating agencies don't have the tools. They do, misanalyze the transaction, and it's, when you got 50% credit enhancement at the AAA, it's easy to close your eyes and just give a stamp, right? But the credit bonds, it is, this is hard collateral to analyze. These are sort of bespoke deals, and not every agency, I think, has the tools or the staff to be able to dig in as deep as we do.
I thought you were going to agree that with his comment earlier about subordination levels being too large, but
for the agency that doesn't go down the stack. I do agree with that. Yeah.
Are there other questions? All right, then thank you. Thank you to our panelists. Thank you for sticking around. Appreciate it.